Hello, everybody, and welcome to another episode of Making Credit Common Knowledge, where basically our goal is to share credit advice with you in an easy to understand way so that not only you can apply it in your own life, but also so that you can share the information with children, with your friends, your family, anybody that is in your circle, so that hopefully we can all kind of work together to help everyone understand credit, how it works, and kind of just make credit common knowledge. So before I get into our topic today, though, I want to introduce myself as well as the guest that we have on here today. My name is Curtis. I am the social media manager here at My Credit Guy. And we had two of our team members that were supposed to come on today, Pedro and Amy, but they ended up having to help a couple clients with some very important credit matters. So it actually turned into be a happy accident though, because now we are joined by our very own CFO and fearless leader, Tricia Parker. And on top of that, to top it all off, we also are joined by Crystal Gehrmann, who is one of our account executives here at My Credit Guy, as well as one of our most knowledgeable credit experts on the team. How are you guys doing today?
Excellent. Going to be a great day.
Really good. Yeah, it's Wednesday.
Woo.
That's hump day, baby. So, Tricia, can you tell us a little bit about kind of your role in the company, your background here, your part in the whole big picture of My Credit Guy?
Yeah, absolutely. So I am the COO and CFO of My Credit Guy. I'm one of the founders, and I am extremely passionate about delivering the most amazing customer service experience to our clients. And we have two sets of clients here. We have our clients that go through credit repair, and then we have our referral partners who refer us business. So I find a ton of passion in creating a beautiful culture here where our staff loves to come and work every day and gets the joy of helping people get into homes, and we get to celebrate that. And I love trying to make it just be a really cool experience for our clients to go through too, where they feel empowered and educated at the end and ready to take on the credit world. Personally, I'm a wife and I have two daughters, Paige and Quinn. They're 8 and 6. I love everything about being a mom, and outside of work, I love to golf and be at the beach, and I love outside stuff. So the more I can be outside, usually the better for me.
Very active. That sounds like a very active, very busy life. But as far as Facebook tells, you manage it all very, very well. So
thanks.
I do know that
I try. It is important, I think, for everybody that's a working mom out there, working parent, to find that balance, right? Like the work-life balance, everybody's talking about it. I don't have it figured out yet myself either, if we're being honest, but I'm striving for it. Like it's one of those things where it's on my radar constantly of balancing the two, finding the right medium. When we first started My Credit Guy, I definitely was all in for a lot of years. So I'm trying to kind of realign that balance the last few years, but I think I'm finding it for sure.
That's awesome. What are some of those, like the biggest benefits you've noticed from kind of focusing on finding that work-life balance? Like, I'm sure that has had a major impact.
Yeah. So burnout happens for sure. So you can grind, and I'm a grinder. I can focus in on something and I can work 12 hours on it, no problem. Like I actually really love to work. So where you have to make sure though is that if you do that day after day after day, you will burn out. And the other big lesson I've learned along the way is to celebrate the wins. Forever, we would set a goal, hit the goal, set the next goal, drive. Hit the goal, set the goal, drive, right? You have to celebrate along the way. You have to take spots, go on a vacation, clink your champagne together, go out and get ice cream that night. Like one big thing I've learned along the way that is you don't stop and celebrate when you hit big things, then it doesn't feel right. So it is important, I think, to take the time to make sure you stop and recognize what you've done and then set that goal and go.
Change some switches out, I guess.
Absolutely. Yeah. No, understanding the progress that you're making is, I think, super, super huge for anybody trying to achieve any goal, to be able to look back and see, I did this. And so, yeah, stopping to smell the roses is really, really important. Crystal, tell us about yourself. Tell us about your role at My Credit Guy. Tell us about a little bit about you. We're curious.
So in, I think, like 4 days, it'll be my 3-year anniversary of being here at My Credit Guy. So I'm really excited for that. I love my job. I originally started off as a credit coach, did that for a while, was a team lead, and then now I'm actually an account executive. So instead of working directly with the clients, I'm working with our referral partners, so like our loan officers and realtors, and helping them out. It's been a crazy ride. I love it here though, and I can't wait to see, as we continue to grow, where I get thrown into, because it's just always fun. It's always a good new experience. And, as we get larger, new roles are coming out, and just getting that opportunity to help wherever I can. The biggest thing I think for here is you have to be a pleasure to work with. And I cannot stress enough, it's a family environment here, which is awesome because we spend most of our time at work, right? So the fact that we all joke around, we hang out, occasionally hang out on our free time, it's really cool because it's not just work. It's, you're creating that friendship with everybody too. On my free time, I like to play softball. I play on a couple different slow pitch co-ed teams. We actually just went 19-0 in our last season, which is the first time we've done that in a while. And we got moved up to a higher division. So it was awesome. The second to last game, I almost hit a home run. So that was exciting because softball, the slow pitch fields are significantly longer than the fast pitch fields. So I didn't even think I could do that, if we're being honest. So that was cool. Other than that, I used to coach club softball team, and then I have a dog, so I spend a lot of time with her. And then I don't know, I just hang out with my friends and my family, like to go swimming, like to play basketball, hiking, kayaking, pretty much anything that we can do like outdoors, especially during the summertime to get a good tan going on.
Love it.
That's awesome. That's awesome. It sounds like both you guys are hustling outside the office and inside the office. Those are two great qualities to have. That's amazing.
Absolutely. I do think for us worker bees inside offices, right? Like it's like we yearn to be in the sun and get out there too sometimes. So yeah, I think a lot of us spend a lot of our weekends trying to get that vitamin D kind of balance out the inside part of our jobs.
Getting on our feet for sure.
That's got to be easier in Arizona than here in Iowa. You guys are out in Arizona in our Arizona location, and we also have our Vinton office here. So we're actually about to be getting some sunshine heading our way this weekend. So we're really looking forward to that out here.
Yeah, I know. You guys are in the beautiful time of the year though, where you're like tulips start to bloom and the daffodils start to pop out. Like I love spring in Iowa too. So you guys are definitely headed in to a beautiful, beautiful season. Here we're like we get like one more really solid month of it not being too crazy hot, and then it starts to be a boiler. So yeah, you'll find us all outside for this next month. Try to soak it up as much as we can before it gets a little too spicy even for us.
Yep.
Awesome. Well, thank you both for kind of giving us some of that background. I learned something new about each of you every time I talk to you, and it's a pleasure every time. So kind of just rolling into our topic here, talking about the 5 sections of the credit score algorithm. Another way to put that is just the 5 factors that go into calculating your score. I can't stress enough how important this is as far as it relates to credit, because really it's the foundation. It's like the building bricks of understanding your credit score. Am I wrong about that? Am I right?
You're 100% right. So I'm super analytical, right? So I love when I got to see the breakdown of the percentages of what things factored in, because it's like having the key to the treasure chest, right? Like I say all the time, like why clients fail is because they don't know what they're doing. They haven't been taught Or Joe Schmo told them some crazy tip that they've been following for 6 years now with no prior experience to understanding finance. It was something he read or heard from his neighbor or whatever. So this is a really important topic because when we break it down for our clients, it's like a light bulb goes off in their head and all of a sudden they're like, oh my gosh, this isn't that complicated. I didn't know. I really just didn't know. So yes, absolutely. It's really just all about a formula that we can see.
Yep.
And Crystal, I know that you both have a history of working directly with clients, but Crystal recently just transitioned from working directly with clients to also working with some of our referral partners. What kind of things do you see as far as the way that most people understand the credit scoring algorithm, Crystal? Do most people enter our program understanding the credit scoring algorithm? Are they kind of lost on it? Like, what's the general kind of understanding there?
I think they have like a basic understanding of it, but when it comes down to, like Trish said, like I'm very analytical as well. Most of them don't know those percentages. So they'll think that like inquiry, it just kills your credit score. And they're thinking it makes up like 50% or something. It's like, it's just like a very minuscule amount. So when you get to break down those percentages to them, a lot of people don't realize that the payment history is the biggest, or the credit cards are the biggest. And once you explain that to them, and then help teach them how to play the game on how to utilize that to their benefit, that's really when you see like that aha moment where it's like, click, light bulb, it's on. Now I understand that, yes, sometimes, funds are tight, whatever, but if I'm going to pay something late, it's going to be something that doesn't report to my credit, because something that does is going to have a huge impact. Even though maybe they let it go, they don't charge you that late fee, whatever it is, when it gets reported, that hits really hard when it comes to that scoring algorithm. So just kind of educating them on those things and how to be kind of strategic, like it definitely helps a lot getting to have those conversations. You do run into people that, they do get it. But the more information you give them, the more they really start to understand it. And it makes it a lot easier to have conversations, because now they get what you're saying and they're on board to, strategize with you on how that's going to help them to get back to the closing table.
Yes.
I want to point something out that, yeah.
No, you're fine. Go ahead.
I like how you said that credit is a game. I think that is like the perfect analogy. Because credit really is a game. And I think that once you understand the credit scoring algorithm, like you said, Crystal, it gives you a whole new perspective on how to play that game. So
yeah,
it's like getting the cheat code.
The rules. Yeah, exactly.
Yeah, it's like the cheat
nobody's
code.
ever told you what the rules are, and you're just like, well, I'll do what my common sense says. The problem with credit, unfortunately, is that common sense and credit don't always align. That the credit bureaus created their own version of what they're looking at. So does common sense sometimes make sense with credit? Yeah, it does. But sometimes what you would naturally do doesn't make sense. So we can boil it down for you guys for sure. There's 5 sections of this credit scoring algorithm that we want to kind of highlight. The biggest one, the most important one, it's worth 35%. Okay, so over a third of your points go to payment history. So specifically talking about when you open up lines of credit, installment accounts or revolving accounts, do you make your payment on time every month? When you don't make your payment on time, they give you a 30-day grace period before they report it to your credit. But if you don't get that payment in, that late pay, that hit, has a tremendous negative impact on their credit. And this is something I want to highlight, because I have a lot of people that say, it was just a $10 credit card payment. I could have paid it. It was no big deal. I have the money, right? It's not about the $10. It's about them figuring out, when you take out a loan, are you going to pay it back on time? So payment history is worth 35%, you guys. So like Crystal was saying, you have to know that, because if you have to make your minimum credit card payment before you maybe pay like your Verizon bill, Like, not saying don't pay it, but just saying if you're going to pay that 5 days late, that's a better one to pay because that's not on your credit. Pay your mortgage on time, pay your credit cards on time, pay your auto loans on time. And you do have that 30-day grace period. So if you paid a few days late, you're going to get a late fee on your report. Sorry, not on your credit report. You're going to have to pay like the $35, I didn't pay it on time, but it's not going to report to your credit yet. So they do give you a little window there. But if you go past that 30 days and you pay it late, even hiring somebody like us, we're not able to remove those if they're accurate. If they're inaccurate, we can, but if they're accurate and you really didn't pay it on time, the only thing that's going to help is time. It has to heal now from more good pay history being built up. So we want to put a lot of emphasis on this one because it's not something we can fix. You have to drive your own credit by paying things on time.
Yep.
And since, I mean, your credit score has a lot to do with like your behavior. That's what they're looking at. It's your financial behavior. I guess it makes sense that pay history is such a big factor because that is a direct demonstration of your behavior.
100%, right. What they're concerned about when you're going to get a mortgage is if you didn't pay your $10 credit card payment on time, how in the world are you going to pay your $2,000 mortgage payment on time? Right. That's exactly like that's exactly how they're looking at it. So I think people, again, they get lost in the amount of money that they should have paid or didn't pay or how little, or, you know, it wasn't that much money. That part just has no factor in it. It's just whether you paid it on time or you didn't pay it on time.
Definitely. I know our CEO, Sam Parker, always says there's no such thing as a little late pay. And yes, you hear that all the time. And it's so simple, but it's so true. Like you said, like a $10 late pay versus you missed a payment on your mortgage. Like it doesn't matter. It's all the same. So,
they all factor in the same way. Yeah. Doesn't matter what it is. It all hits the same. Yep.
Exactly. Yep. Absolutely. So yes, I think we harped on that one pretty well. But 35%, you guys, like I was honestly, when I learned that, I was kind of shocked that makes up that many points. But it does make sense because they're trying to figure out the big picture. The next biggest one was 30%. We're 30%. So now we're at 65% of your score between these two things. That's a lot. The second one is amounts owed. Crystal, I'll let you hit on this one.
So amounts owed is your balance versus your limit on a credit card. So if you have $1,000 limit, what is your balance to that limit and what is that percentage? So they factor it in two separate ways. One, cards individually. So if you have 5 cards, it's what's your balance limit ratio on each card. And then they do your overall utilization. So what is your overall balances versus your overall limit? So that's kind of where I was talking about, like playing the game. Sometimes you're going to have some cards that are a little bit higher, but if your overall balance limit ratio or utilization is under 30%, typically we're going to be okay because the overall section is under there. But when you get into the game of, you know, the overall and the cards being over 30%, that's where you start to see some damage, definitely over 50%, because now it's just you're part of it is like trying to borrow responsibly, right? So when they're saying if it's over 30%, they're a little worried, but over 50% makes it look like you got some financial things going on. And they start taking points for that because you're over that percentage. So credit cards, payment history combined, 65% of the credit score, just simply off of that. Obviously, you have other accounts that you have to pay on time, but credit cards between those two typically impact the biggest portion of the score because that's the only account type that double dips, right? You have a 30% and a 35%. So that's typically where we see the biggest thing when we have people come to us, whether they get enrolled in our services or not. If their scores aren't where they need to be, I would say probably about 70-75% of the time, it's because they either don't have cards open or they do, but the balances are way too high. And that's what's suppressing those scores because they impact those two different categories.
Yes, absolutely. And Crystal just touched on too that it's important to note that it's revolving accounts that is where that comes into play. The difference is a revolving account is a credit card or a line of credit. or there's installment accounts or mortgages. Installment accounts is like your auto loan, your student loans, right? So that's like a one loan where you have a set amount you borrowed and then you pay back payments. The installment accounts, the student loans and the car loans, you don't get extra good credit by paying those down under 50% or under 30%, what Crystal's talking about. It's only credit cards that part factors into. So I've had some clients hear this information and then they immediately go and put a big chunk of money down on their car loan. That's good as far as it'll save you interest on your loan because you're not going to be paying back the loan so slowly, but it will not, and I repeat, will not help your scores to do that. But credit cards, holy cow, that makes a big difference. So the other thing that's kind of important to note is what Crystal also said is when people don't have any credit cards, they're missing that 30% chunk too, because there's nothing to be graded on. There's no information for us to get from that. So that is why a lot of times clients need to go open up a small credit card that they use super minimally, because again, they're just playing the credit game. It's a rule to the game that they want you to have a revolving account. They want to see how you use it. It's a big, big chunk.
Yep.
But yeah, great information with that.
If there's anything anybody takes away from today, I guess it would be those two factors right there. I mean, just between 100%. Those two, like you said, 65%. Wow.
Yeah. So pay things on time, keep your balances under 50% on your credit cards. It's okay to use credit cards. It's definitely okay to have some. We want you to have some, but just pay them on time and keep them under that 50% high limit mark. Before you're going to get a mortgage, you're going to want to get it under 10% of that high limit to maximize your scores, not to zero. It's better to keep a small balance on there than to pay it all the way to zero, but always making sure you pay your minimum payment no matter what.
Yep. Put that thing on auto pay.
Yes. Set it up to set it and forget it.
Set it and forget it. So let's say everybody's already working on those two things. You're like, hey, look, like, you know, my pay history is pretty solid. I'm good on those two things. What else can I work on? What else can I do to boost my score? How can we talk about that? As far as the remaining three factors go.
Yeah, so the other chunk of points comes from your length of credit history. So that's really a timing thing. How long have you had your accounts open? When did you very at the very beginning start building up your credit? That's going to help you get a score. If somebody comes to me today, they have zero credit, they have never gotten a credit card or an auto loan, they don't get to jump right to an 850 because of this portion. They have to build up. Time has to pass. You have to show that over months of time, you will pay on time. So the length of credit history does come into play on this. It's only worth 15% of the overall scoring algorithm, but it's enough that it will keep a 700 for a while, meaning, you know, it can take years, unfortunately, of pay history to get to that 800 mark. It's not one of those things where you can just be like, snap, I want it, I got it, like I'll pay my credit guy money and get there. I can help you get the steps in motion, but sometimes it is a matter of just more time has to pass and you have to keep playing the game of paying things on time and showing you're responsible, keeping your balances low, and it will steadily keep climbing if people just follow that method.
And that kind of makes me curious really quick. Is it hard to do that on your own? Like, I know that like when something takes a lot of time to complete and it's something that requires consistency, that can sometimes be challenging to do on your own. And that's kind of where we come in, and the whole coaching aspect of My Credit Guy comes in. Can you talk about how that kind of can be beneficial to people who may be concerned about doing that on their own? Crystal, maybe since you can, or Tricia.
Yeah. So, I mean, there's a couple things that come into play. Like sometimes when you're just young, right, there's no fast forward button. You're just young and you have to build it. Now, the good thing is you don't need an 800 to get a mortgage. You can get a mortgage with a 640 credit score. So the lenders aren't going to they don't need you at that perfect place yet. I'm just saying, like, it does take a little time to get there. For people that are trying to fast forward it, the best place to look at is like your own family, meaning, does my husband have a credit card that that our family as a household has been paying together now for the last 5 years, but only his name's on it and my name's not on it. So what you would want to do is call and add your name to it so that you both get that same history flowing through. You might as well. It's your family. If your family's paying for it, your family's paying for it. So there's definitely some tips and tricks there. The other thing to just be cognizant of is when you go get an auto loan as a family, thinking about putting both of you on the loan so that you both get the pay history on it. There's things that you can, as long as you proactively are considering like this is going to be a positive for both of us, or if you have a credit card, I should have a credit card. We should both be building ourselves up. I think it's very important. I've seen a lot of times with clients where the husband's credit is always the one they use, and the wife, they don't use hers. It's just the husband does it, right? Well, what happens when the husband loses his job and then now he doesn't have the income? He has the credit, but he doesn't have the income, but the wife has the income, but not the credit, right? So I don't like that. I don't like the whole one of you gets all the credit stuff and the other one puts their head in the sand. Don't do that. Be educated. Both of you should have good credit. Both of you should have your own stuff. You should have stuff together too. If you're concerned that your person you're signing with isn't going to pay the account, then don't get on it. Like, yeah. Don't, like, hopefully it's not going to be your spouse, but just saying, like, if it's your sister and she wants you to co-sign and she's 18, don't do it. Like, unless you're willing to make the payment for her every single month, don't do that. Make sure you're only choosing specifically for your family in your household, but build both of you up at the same time, because you just never know what's in the future or how it's going to play out or how it's going to help you. When you go to get a home loan, if you can use both of your incomes, you're going to get a better house, bigger house, you get more money allotted to you. If only one of your incomes gets to come into play, well, then that's what they factor on. So don't put your head in the sand and wait too long, because if you wait too long and then now you're trying to build up credit and you're 40, well, it's going to take a few years. There's no magic wand to speed it all up.
Well, and as a single younger person, really starting out of the gate on, getting cards open, things like that when you're younger is great. Making sure, obviously, you're paying them on time, things like that. But if you haven't been able to establish that until more recently, like Trish was saying, like my personal experience, I was looking to buy a house about 2.5, 3 years ago. I had already had a couple credit cards open for about 4 or 5 years. I'd had a couple auto loans, things like that. But I mean, as a 27-year-old, I'm not going to have a 750, 800. First off, I haven't been alive long enough to have something like that, right? Because most of the time you don't get a credit card till you're 18, you're 19, whatever. So going back to like reaching out to family members, things like that. Like my Nana is amazing. She added me as an authorized user onto a couple cards she has that have been open since 1995. I was 5 years old when these cards were open, and when they hit my credit, because she's great at keeping the balances low, she's never made a late payment, right? All of a sudden I went from having just a couple years of history to history for almost as long as I've been alive. And that really helped to increase my credit scores, because now I have this length that I didn't have before. But because I had created that solid foundation on my own and was working to build that, when those were added, it really did help boost those scores, making it so my scores were higher. I think a lot of people run into, oh, I can't buy a house on my own. Like, I can't do that. You can't. You totally can do it. You just have to work for it. You got to make sure you're building, your scores, you're doing your things you're supposed to. And I'm not going to lie, it is harder to go through that process by yourself, but it is possible. And the end result, when you do have that home, it's the best feeling ever. Like, I remember when I got the keys, I was just so excited. And I was like trying to unlock the door, but I was so excited, like I got the key stuck and my mom had to help me. And then just opening that door, looking at my mom, closing it and locking it. It was like that. Ooh, this work that I've done over the last like 7 months came to fruition. And it was the best feeling I have probably ever experienced in my life. Like, this is one of my major milestones that I've had, right outside of like graduating college, things like that. This was my first like big adult thing. So for younger people that are trying to do this on their own, like you can do it, but you really do have to play this game. You have to understand these things. Being added as authorized user onto people's cards, make sure there's no late payments to keep their balances low. That is a good way to help, supplement and boost those scores too. Even though you are technically kind of doing it on your own, you are having some help, from somebody that, is going to.
Yeah, I will throw it, and that's Crystal. I was so excited when you got your house. We were like all excited, like we were all working for it, like together. I felt like
yeah,
we were all in it. And it was that's awesome. And you're so young to already be a homeowner. Like, what a great asset already put in your pocket. Like, incredible, right? The other thing I will throw a tip out there is, a lot of times parents will finance a vehicle for their kids when they turn 16, right? Like, you'll get them a $3,000 or $4,000 car or whatever the case may be, so that they have their own car. When you go finance it, it's super smart. Like, my dad did this for me. He added me on the loan. He still paid the payment for me, I will say, because I was 16. I wasn't ready to take on a car payment yet. But him adding me onto that, I bought my first house when I was 20 because I had that amazing pay history for 4 years, paid it on time every month, and I was on it. And then when I was 18, I got a credit card. So then I had an installment and a revolving that was paid on time. That made it so that by myself, I could buy a house. So it's not rocket science in the way that you just have to follow the rules. But where it gets confusing is, say my dad co-signed for that car with me and he wasn't going to pay the payment for me, and I was left to pay the payment. If I wouldn't pay the payment, it's going to hurt my dad's credit too. So that's where it gets a little hairy, is you can only get into situations like that if both parties involved agree that no matter what, this payment is going to get paid. So who's going to make sure that that happens? In this case, it was my dad. He was financially savvy at the time and in a good spot to be able to help me with this $100 payment, right? But just making sure, I see a lot of times people will co-sign for their kid. The kid's supposed to make the payment. The child doesn't make the payment. And now the nice parent sitting there with their credit being hurt when they either just shouldn't have co-signed, or they should have kind of set up their own auto pay of, no matter what, I'll pay it and you pay me the money, or whatever the case may be. There's ways to go about it, though, that you can definitely figure it out and work as a team to get yourself where you're trying to go. But yeah, definitely there's some ways you can kind of circumvent the system to some degree to get that pay history faster by adding on with loved ones or people you truly trust.
That's awesome. That's all really, really good advice, guys. So I just want to quickly run through just the 5 sections here, just to really briefly recap for our viewers here. The number 1 factor of your credit score is your payment history, which is 35%. After that, we get into the amounts owed, which drops down to 30%. So with those two together, we're already at 65%, just between those two. And then we move on to length of credit history, which is 15% of your score. And then we get into mix or types of credit used, which is 10%. And the last 10% is new credit or new accounts that you have opened. So if anybody has questions about this, if you are wondering about fixing your credit or building your credit score back up, whether it to be get into a home or to buy a new vehicle or just for to prepare for the future, go ahead and click on the link that I'm about to add in the comments below. It is you-made-it. And you will be able to reach out to us there, and we would be more than happy to hook you up with one of our credit experts, get you a game plan to get you where you need to be. Thank you, Tricia, and thank you, Crystal, so much for your time. I know you guys are both super, super busy today, so it means a lot that you were able to hop on here and share some wisdom with everybody.
Oh, yes, our pleasure for sure. And thanks for hosting it, Kurt. You're wonderful as always. And Crystal, great information, and congratulations early on your 3-year anniversary. I'm excited to celebrate on Friday with you.
Thank you. Me too. Me too. Thanks for having us, Curtis. I appreciate it.
No problem, guys. Thank you.